Hi there. In this video, I'm going to talk to you about unsecured lending for your business. How and when to use this form of finance, and then how to move on to more cost-effective forms of financing. In the early stages of building your business, in the first 3 or 4 years, it's unlikely that the business would have accumulated any assets of substantial value. A startup business in the early years acquire operational assets such as vehicles, machinery, IT equipment, and furniture, all of which depreciate. Consequently, financiers offer businesses in the early stages a very narrow scope of financing solutions, invariably in the form of unsecured lending. Before I explain to you how you might use unsecured lending in your business, I want to make sure that you understand what is meant by the term unsecured lending. The best way to describe this is to compare unsecured lending to asset-backed finance. Asset-backed finance, as is obvious from the term, is finance backed up by an asset. The asset serves as collateral for the loan. Asset-backed finance may take many forms. Vehicle finance is a good example. The vehicle has monetary or collateral value. The financier uses the collateral as an anchor for the loan. If the lender fails to honor the terms of the loan agreement, the financier may attach or repossess the asset in order to recover some of the capital. In contrast, unsecured lending is a form of finance where there is no asset that serves as collateral for the loan. As a result, unsecured lending is usually offered at very high interest rates. Also, the term over which unsecured lending is provided is usually rather short, and the amount of capital on offer is usually limited. Early types of unsecured lending products take on the form of a term loan over a specified loan term at a fixed or variable rate of finance. Today, financiers offer a variety of solutions. Some of these solutions work like an overdraft or a revolving credit facility. Some offer a deferred payment structure. Some offer a fixed cost structure, where others offer finance cost discounts at various points in the loan term. New generation financiers have become very creative in the way in which they structure unsecured lending products. This type of financing solution, though expensive, is a great way for a business in the early stages of its development to access capital. What typifies unsecured lending is high rates of interest over relatively short loan terms, and limited amounts of capital is made available through this type of financing solution. Consequently, the monthly debt obligation of unsecured lending products is high, which of course means high finance costs, but also impact the business in terms of its cash flow. When assessing an application for unsecured lending, financiers consider a variety of factors, but 2 factors stand out: the financial conduct of the directors or the owners of the business, and the cash flow that's being generated within the business. In fact, many financiers that offer unsecured lending solutions do not even ask for the financial statements of the company. They rely on a personal credit report on the directors of the business and bank statements over 6 to 12 months. More than any other factor, financiers look at how the business generates cash flow from sales over time. Financiers offering this type of loan almost always will insist that the directors of the company sign personal surety for the loan, and often will want to have sight of the personal statement of assets and liabilities of the company directors. Financiers in this segment of the market make very little distinction between the business and its owners. Unsecured lending is a good option when the owner of the business can draw a direct relation between the need for capital, how the capital will be used within the business, and the means by which the business will repay the loan. A good example of when unsecured lending can be used is for financing inventory. A retail business must procure stock to sell in its stores and must make a calculation, which I admit may vary in complexity, but essentially what the business owner needs to get to is the gross profit margin. The cost of sales of a typical retailer may include the cost of purchasing the inventory, delivery costs, and insurance. When using any form of financing to procure the stock, finance charges has to be included in the calculation in order to determine the overall profitability of the trade, but also to decide if it is viable to use financing as a funding mechanism. The little bit of hair that remains on my head, don't laugh, literally stands on end when an applicant tells me that they need capital to fund expenses, or they give me some arbitrary, fuzzy answer to why they need to find funding. You must be crystal clear about why you need capital, how you will deploy the capital in your business, and how you will repay the loan. Without clarity, you have no way of assessing the viability of entering into a loan agreement, and you endanger your business. Soon, you will become a slave to financiers. Don't let this happen to you. Your job as business owner is to develop your business in such a way that you can move away from using expensive forms of financing to more cost-effective ways of financing business needs. You accomplish this by doing three things. First, separate personal from business finances. Then, focus absolutely on managing cash flow. And lastly, you grow the asset base, the balance sheet of your business. The first thing that you must do is to separate personal from business finances. It confounds me how often I still see entrepreneurs running personal expenses through business bank accounts. No serious financier wants to spend valuable time sifting through bank account statements, trying to decipher and separate personal from business expenses. If you want a financier to take you and your business seriously, you must stop using your business bank account as your personal piggy bank. Only run business expenses through your business bank account. The old cliche, cash is king, still rings true. Financiers look at businesses and distinguish between good and poor prospective lenders by focusing on cash flow. Strong cash flow is a function of growing sales, maintaining a tight grip on expenses and managing risk well. But it's not only about the numbers. The results contained in your cash flow statement is a reflection of your competence as a business manager. Financiers, like all people, like to do business with people they like and trust. Competent people are trusted. The only way in which a business becomes a self-sustaining separate entity is when the business achieves operational and financial independence. A business that accumulates appreciating assets on its balance sheet is in a much better position to negotiate cost-effective financing options. Financiers are then also much more inclined to distinguish between the business and its owners. As you separate personal from business finances, manage your cash flow effectively, and grow the asset base of your business, a world of financing options will become available to you. My name is Dion de Bruin. I started Constructum Consulting to help entrepreneurs raise capital from financiers and investors. If you need help to develop an effective funding strategy, you may contact me directly. To develop your skills as an entrepreneur, and in particular your skills insofar as it relates to business finance, visit Constructum Online Learning on YouTube. Thank you for watching, and all the best with your business.